Yeah, thanks a lot, Mr. Fed. And without further ado, please welcome the distinguished panel to discuss these issues, which is Roland Boekhout, Wolfgang Kirsch, and Michael Rüdiger. I thought that we have 1 hour to discuss this, I think, as Mr. Fed said, very, very important issue and very core issue to the future of banking. And we start immediately just by me allow me to make some introductory remarks, and then we immediately start the discussion. The panel is called The Transformation of Long-Term Finance, and I would like to basically add the subtitle and the future role of banks in long-term finance. I think that is at the heart of what we are discussing. What are the strategies of institutions in this field? How do banks develop? What does regulation mean for banks? What does the new competition mean for banks? What does the current market environment and interest rate environment mean for banks in long-term finance? And how will that work out? And what are the strategies of those proponents on the panel with me to make sure that their institutions are successful in this field in the future? I don't need to introduce all those 3 heavyweights, as you said, of the financial center in Frankfurt. You might rather ask, who is this moderator? I was introduced properly by Mr. Fed, and I will just really do some very short introduction on the 3 people joining me on the panel. Mr. Roland Boekhout joined ING in 1991, has held many management positions nationally and internationally in the group, and since 2010 has been the chairman of the board of ING-DiBa here in Germany, and as we could all read, is about to move on in a few weeks' time, likely at least to join the group management board of ING. Mr. Wolfgang Kirsch, after being at Deutsche Bank in different positions, joined DekaBank in 2002 as member of the board, and then in 2006 became the chairman of the board of DekaBank, which together with WGZ last year formed one of the 3 largest banks, universal banks in Germany. And finally, Michael Rüdiger, having been a foreign banker in UBS and Credit Suisse, where the both of us got known to each other, he joined as chairman of the board of DekaBank, the institution, in 2012. Now, as I said already, banks have a number of challenges that they are facing currently and they are likely face in the future, and the banking industry and the whole financial industry, I would say, is facing a lot of disruptions, and banks are looking to what that means to them and how they adapt to the new environment. I think if you would name the main challenges for banks on a very broad level, it would be regulation, obviously, and we will discuss that a bit, but not too much. The current interest rate environment, including the policy of ECB, digitalization, and as a consequence of that, the emergence of new competitors in traditional fields of banking business. And maybe that is one of the more important issues to discuss today. What does that mean? How can you cooperate? What is the new environment for especially long-term finance for banks? Because long-term finance, I think, is one of the classical areas where banking serves the real economy. It's one of the classical issues where you can prove that banks and the banking industry is an added value to the overall economy in providing long-term finance, in mitigating risks in this process, and in channeling short-term or mid-term savings into long-term needs, in investment needs. And we all on the panel, I think, share the view that banks have to play, not only should play because we are interested in banks playing an important role, but have to play an important role in this area because of their expertise, their long-standing expertise, and also because of their strong regulation compared to maybe other sectors. If you look at the banks, we have quite an interesting panel in terms of the diversity of different business models. And I start with DekaBank. DekaBank is a both bank and fund manager with a focus on fund management, asset manager in the meantime, and kind of stands at the link between banking and asset management, and provides a lot of long-term finance, especially in the property sector. DZ-Bank is obviously one of the biggest corporate banks. It serves the cooperative sector in Germany with all the services they offer. And also, and I think that is quite important, and also something that for us as the Pfandbrief Banks Association is quite important, has a number of subsidiaries that are specialized in long-term finance, and basically their reason for being is providing long-term finance to the real economy. So it will be very interesting to listen to what Mr. Kirsch has to say in that respect. For example, DG Hyp, WL Bank, Bausparkasse Schwäbisch Hall, or DWB Bank, they are specialized providers of long-term finance in different areas of the real economy. And finally, ING-DiBa, one of the largest retail banks in Germany with some 8 million customers, and also a large provider of property loans to retail customers, as well as a corporate bank. So obviously, you can see this is a diverse structure. We are coming from different ends, but the joint feeling is, or the joint approach is, banks are important in long-term finance, and that leads me to my first question, and I would like to ask Mr. Kirsch. What's your view on banking and long-term finance, given the challenges that I have mentioned, regulation, interest rate environment, the new competitors, digitalization? Are you scared, or do you have concerns about the role of banks in long-term finance in the future?
Yeah, everybody, I think, is concerned about the future of banks, not only whether they're able to provide long-term financing, but perhaps the question which role a bank can play in the future in the real economy, given the special conditions. I always name them as double trouble. Yeah, so double trouble means negative interest rates plus regulation. So that puts lots of pressure to our sector. And I have asked myself when I got the invitation to participate here in the panel, so what could be my special role? And you just introduced me and you mentioned DZ-Bank, which is not just a corporate bank, but which is also a central bank to 1,000 local cooperative banks, and is also a holding company. And among those holding companies, you find a lot of specialized lenders, asset-based lenders in the shipping industry, in the real estate industry, in the home loan market like Bausparkasse Schwäbisch Hall. And so far the structure of our business model was that in DZ-Bank, I get indirect retail funding, because we have a surplus of 100 billion euro in our sector, in our cooperative sector, that is not used for the time being for financing the real economy. So it is placed mainly with DZ-Bank, and so we have to find business opportunities where to invest. Obviously, this business model is under pressure, because in the past, when the local cooperative banks placed funds in DZ-Bank, they got a return. Yeah? But nowadays, if I can't bring them into the real economy, I have to charge them negative interest rates. So hopefully, this will change over time. We have all a view about the developments in the interest rate markets, but for the time being, I think we have to calculate with negative but low interest rates. I'm just coming from our management conference, and we have ambitious plans to improve our market position in Germany. In the corporate market, it is 21% as a group, and we want to get to 25% in 2020 plus. You never know. We want to grow in the real estate market. which is commercial real estate, and its retail business. We want to grow perhaps once the market change, like ships, aviation, who knows? Some will disappear, and then those being left over can finance. And for all these ambitious targets, we need, first of all, funds. And as we are doing our business in Germany, we need long-term funds, because 80% of whatever we cover is long-term business. And long-term business has something to do with liquidity. So you need liquidity. And we and I have realized in 2009, when the markets were difficult, how difficult it is to get funds from third parties if you don't have access to the retail business. Don't forget this. That is one thing. And the other thing is, of course, that the German customers from time to time would like to see stability in the interest rate that is independent from long-term financing, and that is mainly done via the swap markets. Yeah? But both liquidity plus stability in the interest rate is one of the key observations of the German market. So we are very much interested in long-term financing. We need a good business environment. We will talk about which pressure regulatory puts on these topics. But I believe that especially banks will play now and in the future a dominant role in long-term financing, apart from a few other parties, but the dominant parties will be commercial banks and Pfandbriefbanken.
Good to hear. Also business-wise for me. Mr. Boekhout, do you share this view? And ING-DiBa is seen as a technologically advanced provider of banking services, very much at the forefront of also dealing with some of the new competitors that are around these days to offer banking services. What do you think banks have to do going forward to make sure that they can fulfill the role that Mr. Kirsch just mentioned? So being strong competitors and being maybe the dominant force in long-term finance.
Well, I think there's two elements to that. One is the demand also that banks have themselves, which is I think also what Mr. Kirsch mentioned. We have a business model where we, at least some of us, a business model where we collect excess liquidity and provide a way to invest it, lower the risk in the meanwhile for the ones that provide the liquidity. That means we need to fill the left side of the balance sheet. So that is part of our business model, and we want to continue to do that. So yes, banks will do everything they can in order to have access to those to longer-term financing, providing longer-term financing, just inherent in their business model. Now, you can, however, also do that in a different way. And this is a trend that we see currently, mostly driven by regulatory pressure and uncertainty more than anything else, which is that you then become the originate-to-distribute model, which is everybody's talking about it, originate-to-distribute, and I'd be hard-pressed to find a bank that doesn't have a project group working on that. And why is that? Well, because they feel the regulatory pressure, capital pressure, shortening your balance sheet, and eliminating uncertainty in your balance sheet. So banks will, and I believe banks will always play a role in it, because structuring these facilities has a high added value, and understanding the risks in long-term financing is not something that you leave to a market, to be honest. That takes technical knowledge, it takes structuring knowledge, in order to put that in place. And those experts usually you'll find in banks or bank-like institutions. Again, the question then is where does it end up at the end of the day, this asset? And banks will continue to have an interest in it, but there needs to be an economic equation also, in the sense that we need to be able to keep it. The capital requirements need to be adequate for it, and need to be assessed also. I can't take a 15-year-long asset on my books with the risk that 3, 4, or even 8 years down the road, suddenly the risk weighting of the asset doubles because new regulation comes into force and doesn't grandfather the asset that I already have on my books. That makes it almost impossible for me at the outset to do so. But there's also no doubt that the economies that we're in need long-term funding for projects, for example. So who else is going to provide it if it's not the banks? You know, insurers are actually struggling with a similar uncertainty and struggling with their life book anyway, which is where they need the long-term investment opportunity for. They don't know where that book is going. It's shortening, it looks like, or at least shrinking. And they're struggling with a similar uncertainty on the regulatory part. So, you know, I think both of those are looking at it and struggling with uncertainty, and the market is looking at it, getting increasingly concerned. Where is the long-term funding going to come from? Because it definitely needs to be there. So a logical answer that then is popular right now is you all talk about the capital markets union. That's very simple. Then we create a capital markets union. We don't need banks, we don't need insurers anymore, which is grossly untrue. First of all, once again, you need people that can structure these facilities. And secondly, what I find fascinating is that completely ignored in that whole discussion is that the ones that need the financing may have an opinion also on it. And interestingly enough, the customers that we want to service with these financing instruments tend not to be Americans only, but European companies, corporates and projects, and they like to have a banking relationship. They're not like the Americans necessarily. Americans are very much focused on capital markets instruments to finance both corporates and projects. And a lot of European customers in this context like to have a bank that makes them customized long-term solutions for financing their project. And if there's changes along the way, which happens, they don't refinance through a repayment of a capital markets instrument and putting a new one in, but they go to the bank or the bank consortium and refinance that way. So I also believe that demand for long-term financing looks different in a European context than it is in, for example, a North American context. And that seems to be completely forgotten in that discussion. So I think banks need to play a role because it's the business model that forces them to do so. Customers also want banks to continue to play a role in long-term financing. And the market in general has a high demand, increasing demand, as a matter of fact, for providers of long-term financing. And the alternatives are not imminent. So banks will have to be part of the solution.
From a personal perspective, I agree. If you are a lobbyist, maybe it's a biased view of a lobbyist, and if you deal with all these papers coming out of Brussels, then you sometimes have the feeling, not so much, I mean also concrete regulation like Basel IV that's making it difficult maybe to in the future provide especially low risk long-term finance to the same extent that we have today, but also what they call, for example, communication about the capital markets union, about long-term finance. They also communicated about long-term finance, and the interesting thing, it was in 2014, the interesting thing, the whole paper, there was one mention of banks, and that was because of covered bonds. Yeah. And everything else, they were basically looking for new alternatives to raise funds for long-term finance. And I think that's, to a certain extent, what you're mentioning. Yeah, there is a need for banks. I think there is also a need for banks with regard to the expertise that banks traditionally offer in this field, which is maybe not as deep in other sectors. But you can ask the question: is the political will, or is the political strategy indeed to basically open up and not get rid of banks, but make them less relevant than they have been in the past? And we will come back to that in our further discussion. Mr. Rüdiger, you have basically two views maybe on long-term finance. On the one hand, as I said in my introductory statement, you are a bank providing property finance. On the other hand, you're an asset manager, and I think this is the more dominant role that you currently have. And for me, the question is, how do you think, given your two perspectives, how do you think long-term finance will develop in the future? What will be the suppliers of long-term finance, and what are maybe also the forms of cooperation that can be found between asset management and banking in providing long-term finance?
Yes, certainly in the world, as Mr. Kirsch called it, the double trouble world, we monitor carefully what is going on in terms of capital market union, and Roland just said it. It is certainly quite different when we watch how the banking and financial market structure is comparing Europe with the US, and I think these numbers have been mentioned quite frequently. Just want to repeat them. In terms of sum of outstanding corporate bonds in percentage of GDP, this was 2016 data. It's 10% outstanding corporate bonds of GDP in Europe and slightly above 30% in the US. So the corporate bond market is much more liquid and it's much more common. And probably what our view, and you said it's two perspectives we're having from an asset management perspective. You can imagine in the world of record low interest rates and search for yield from each individual investor, there is probably one category of investors who is significantly even more under pressure, which is a category in the segment of liability-driven investors. And you can imagine in terms of demand of corporate bond and being that quite an attractive asset class, we monitor quite carefully what the impact might be in a positive sense, stimulating the growth of the corporate bond market in Europe. But probably we recognize we don't expect that there is a jump start because of a capital market union initiative. But just to give you some numbers, in our asset management company, we manage already 30 billion euro in corporate bonds. So we are much more focusing on this asset class in terms of market liquidity. And now we are coming to the banking side because corporate bond markets have to be liquid. We need market makers. And here we are back again in terms of impact of regulation on banking and not in the primary market, but in the secondary market environment. So this is something we monitor very carefully. In terms of market potential, certainly we try to advise these liability-driven investors, and this is a global trend, to focus more on alternative investments. And to some degree, you end up in quite illiquid product and you end up in debt funds. But honestly speaking, the growth of the debt fund market in Europe and specifically in Germany is certainly to some degree in competition with significant investments for an insurance company. And certainly, and now I'm talking as a representative of a bank, we are quite interested ourselves to lend on balance sheet and to originate attractive risk return profiles. So this is to some degree still limited growth. Overall numbers, if you look into the private debt market, it's probably 25% of the global market is European. And again, it's very much dominated, the global private debt fund market is very much dominated by liability-driven investors. This is public pension funds, it's private pension funds, and certainly its foundations facing the significant pressure of the interest rate environment.
If I may add to that or ask, in addition to that, is what the motivation is of these investors? Is it, again, a preferential regulatory treatment because it's an attractive way of investing in an area where it is still attractive, which would mean that this is in a way some kind of replacement of on-balance sheet lending by banks, by off-balance sheet lending through pension funds, insurance companies, and so on.
If you would be the chief investment officer of a foundation, a liability-driven investor, and you would face the need of generate a return of 3% per annum, it's certainly that you have to look into higher risk profile investments, and certainly you have to look into if this is corporate bond market, if this is more illiquid product. I don't think that this is too much driven by regulation. It's very much driven by the need to generate returns.
But is also and always linked with a certain danger, because you take concentration risks in one asset class. And I mean, I just listened. I mean, we are also asset manager. We have the Union. We have also we have also an insurance company. Yeah, I'm the chairman of the R&V. Just published its numbers. They want to grow. And in the past, interestingly, the insurance companies were those who invested heavily in bank bonds. They are a little bit more careful these days because seeing all this bail-in exercise that is linked with unsecured bank bonds, which is obviously the new hybrid in our world, that risk return with these bank bonds is perhaps not sufficient. But the question for them as well, I mean, they have obligations, especially in the life insurance company, how to invest, because the life insurance business is a 30, 40, 50-year decade business, and investments sometimes are only for 10, 15 years. And if you want to buy bunds and so on, you know what you get. It is not sufficient to cover the obligation. So one alternative could be to climb the risk ladder and to buy in so-called alternative investments. But it will be perhaps 2 or 3% of the overall investment. And I'm quite sure that the insurance company market will not be able to disintermediate the banking industry, because some people hope, I mean, we all would be happy if the IOPA would be our regulator, because they're a little bit more generous, compared to the ECB. But at the end, it is more or less the same. The longer, the more equity, and that's what the insurance companies feels, and they have to cope with it.
Mm-hmm. With regard to what you, Mr. Boekhout, mentioned with regard to originate to distribute, it's a little bit connected to what Mr. Kirsch just said. Is this a wishable outcome of regulation that banks move to a originate to distribute model? I mean, they have to. I understand that. Yeah, it's you mentioned that every bank basically has such a project. The question for me is, and it has been basically in connection with Basel IV or Basel III accomplished or whatever you call it, that I've asked myself, can it be the aim of regulation to have a move to the American originate to distribute model coming from an on-balance sheet lending that we think at least is part of the stability of the German lending system, of the German financing system? And what would you answer to a regulator, clearly working in this direction?
The truth generally lies somewhere in the middle, and I think the movement that we see today when it comes to long-term financing for banking institutions in combination with the argument for the Capital Markets Initiative tends to be too extreme. And so originate to distribute is in principle nothing new. Everybody's been doing it. It just becomes a much more active ingredient today in order to defend the negative effects of regulation on my balance sheet. So I need to do something else. I still want to service customers, so I go into originate to distribute. And that is all okay-ish, because all the elements that we talk about, we need funds, we need insurance companies, but we also need banks in order to play a role in it. And don't get me wrong, I'm very much in favor of developing a very strong European capital market. I mean, there's no doubt about it, and we need it. We need it for liquidity, we need it to really meet all the financing demands that we have in Europe. We need it to be a serious player on a global scale as a capital market in Europe. So we in immediate and serious demand of developing a capital market. It shouldn't go hand in hand with creating a disincentive for some institutions like banks, but also like insurance companies, to be active in this field as well. And that is the part that is disturbing me a bit, because I think it's not supportive. And once again, they're potentially disrupting the business models of these financial institutions. The very financial institutions, they're there to make more stable rather than less stable. And secondly, they completely forget about the demand in the market, right? And yeah, if there's companies, we've seen that in the beginning with the over-liquidity in the market, also in Germany. There was a lot of supply in the market, and bonds were becoming more and more loosely structured, longer and less covenants, and it was all great. And foreign investors coming into this market, everybody struggling to get in there. And then you're going to wait for the moment that these things are going to go wrong. And then there's a European issue. Once again, it all goes back in client behavior and goes also back into legal structures. Then a covenant violation took place on a bond, one of the few covenants that are left. And then a company sits there and said, okay, what am I going to do now? Who do I talk to? We're not used to that. You know, we're used to call our banker and says, I have an issue there, and we're going to sit down and we're going to work it out. Now I have a bond, and suddenly a bondholder shows up at my door and says, by the way, I got this bond and your covenant is not in order. Let's talk. And then a very nasty situation occurs. That is very common in the US market, but it's not common in the European market. Yeah? And therefore, the dominance, or not the dominance, the relevance of the traditional financing, European traditional financing models, namely banks, insurance companies, and also funds, which essentially are also customers from the originate to distribute, it remains an important factor, and it's under-highlighted now. We're becoming too extreme in this discussion, and creating the disincentives for financial institutions to have long-term assets on their books. Which, by the way, the appetite is also limited. Depending, of course, a life insurance company has a bigger appetite for longer-term assets because of the maturity profile that Mr. Kirsch described. In a universal bank like the one that I'm leading, we have a much shorter maturity, obviously, because of a very large savings book. So we have a different maturity profile and a much more limited appetite for long-term assets. But I do have it, and I also want to have the access to it in order to create stability in my own business model. And if it's been made impossible for me to offer these products because of mostly regulatory requirements or uncertainty in regulatory requirements going forward, then that is a negative influence on my business model. And I thought we wanted to make it all more stable.
There's nothing wrong with on-balance lending. Of course, you can walk the street with originate and then distribute. My experience is, as long as you have equity, keep it on your books. Yep. Seems to be a good business. And for me, it is a complete misunderstanding of politics that they enforce us to move this business away from our balance sheets into third parties' business, perhaps to supranational institutions that have always an advantage because they have a very good rating, and for them, long-term financing, backboned by whoever it is easier than if it is backboned by your financial performance. And the main problem of this misjudgment of politics and the misunderstanding of the role of banks comes, of course, from the special situation we're having in Europe. That is the Juncker plan, that is the Green Book, and you know that they would like to face three elements. That is, they would like to see structural reforms, which don't happen. They would like to see financial responsibility, which we can't see. And finally, they would like to promote investments. Investment seems to be the easiest part of this game. They move it away from us, which is wrong. They implement this European fund for strategic investment recourse under the arm of the European Investment Bank. They need us because finally, I mean, we have the relationships to customers. But I'm really a little bit embarrassed about this view of politics on the role of banks. For us, it's a danger. And in combination with a regulatory environment that brings and promotes short-term financing, be it the LCR, be it the leverage ratio, be it Solvency II, the longer, the more expensive. Yeah. So there are wrong incentives in terms of long-term financing for the real economy. And this mismatch, for me, has not yet been solved and has not been attacked by politics.
What's your view on balance sheet versus off balance sheet originate to distribute model? As an asset manager, as Mr. Boekhout said, it should be in your interest to have this kind of disintermediation with banks maybe fulfilling kind of a credit quality assurance process, but otherwise getting liquidity elsewhere?
I would strictly differentiate between the investor type, because some of the initiatives were even thought to be that banks become intermediators in terms of structuring investment vehicles for retail investors. So just think about infrastructure projects, making them probably a little bit more acceptable for a certain regional population, structure it into a private debt fund and try to distribute it into the region. I would strictly warn for that one, because it's for highly sophisticated investors. And as Mr. Kirsch said, you have to understand how your risk appetite is going to be defined. You have to, as an investor, to understand which liquidity risk you are facing. And therefore, I would strictly differentiate the focus between on retail investors and sophisticated institutional investors. For sophisticated institutional investors, I believe there is market potential, and I believe going to be probably stays quite a while as a niche. But in that respect, what could we do as banks? Risk identification, evaluation, and mitigation is still a core competence of banks. Originating, as you said, being close to partners and relationship management type of approach that's common in Europe, going to stay for a while. To gather these assets, structure these assets, do the asset administration. By the way, that's one key issue when you have alternative investments, to administrate them, to do the valuation, to do the reporting, to the risk management. I believe this is a growing business, but it's going to stay probably for a while a niche.
Okay, so we have talked a lot. I mean, so far at least, mainly about the traditional funding structures, maybe except of debt funds, which are a rather but not really new development in Europe. Your first debt fund, I think it was the first in Germany, started in 2009. What are the new kids on the block, and are there any new kids on the block in classical banking, or is this something that is like, for example, we are granting the FinTech Award this evening, like FinTechs that play a dominant role, or may be able to play a dominant role in the area of classical banking, not providing services that help banking reach the customer, but classical banking in terms of platforms where you can basically get loans and invest your money.
Well, yeah, we've been reading a lot about it, less so actually in the long-term products, more in the shorter-term products, the peer-to-peer lending platforms and things like that. I don't know of any example where they've really taken off, and they never go in these long terms. And I can also understand, because I think it underestimates the added value of somebody who knows the credit business and how to structure a facility on a risk. So, you know, as a matter of fact, to a certain degree, this could be a ticking time bomb. Then when it goes wrong badly. You know. On the other hand, you know, there is some merits to it. Smaller loans with really smart data, doing the big algorithms behind it, can provide customers very quickly with short-term financing. But I cannot see a lending platform where we're going to sell mortgages. You know, that is already a harder thing for me to imagine. And so it stays short-term, and I think it generally underestimates or underappreciates the value of the structuring and the risk expertise that banks bring. The regulator, or rather the lawmakers, don't help. I think just now there was another law passed here in Germany, and so the rules are being tightened for direct credit granting, also in the consumer lending area, both on the identification process as on the level that you can grant. And now it's so low that, you know, the numbers the tenors get shorter and the numbers get lower. So from that point of view, I don't particularly see in the long-term financing area a lot of fintech activity that can help us solve the problem, to be honest.
I think Well, I can't report about any competitor that for the time being is successful in long-term crowd financing. You would have invited him and he would sit here on the panel and report very proudly about his success, but you haven't found him. So for me the question is we should more concentrate on the development of capital markets in Germany, knowing that there is difference between the US and Europe. But everybody knows it will move to higher percentages of financing. And all the efforts we have seen in the past, you know, all this segment of Mittelstandsanleihen. And I think now we are ambitious to create a so-called Schuldschein market. For me, that makes sense. Yeah. And we would support every initiative that brings more efficiency and product offer to this market. We all know that the backbone of the German industry is the SME, is the middle market business. And size obviously matters in capital market business because out of a sudden you have certain reporting lines, you have administration, perhaps you have published your numbers, which you haven't done as a privately owned company in the past. You have the problem of a very effective rating process, yeah, so you don't have the money to invite the big fours, the Standard & Poor's and so on. So this dream, yeah, of a very efficient, very less administrative corporate bond market, that should be still a dream, or worth the effort to develop something in Germany.
You believe that something like that develops in the foreseeable future, or is that a dream?
I mean that Deutsche Börse, and we had some initiatives also in Stuttgart and so on, are still working on it. And then out of a sudden, these problems with the Mittelstandsanleihen, yeah, which were a shock, yeah, for many investors, because out of a sudden they realized, oh, ratings can change, you can lose money. Yeah, and this intermediary function of banks, yeah, to make a risk assessment, yeah, and that depositors don't lose money if I lose money in a big corporate investment, yeah, that at least in the past was the conviction why you should place funds with banks, yeah. But nevertheless, we have to promote this sector because everybody knows that banks have certain equity issues. And so if they want to bring certain business away from the balance sheet, they have also to work in the capital markets. And then we have to promote it. And we would be supportive to this exercise.
Okay, I'd like to drill a little bit more into regulation. We have mentioned regulation on basically every corner, I think, so far in the discussion, which is unavoidable, I would guess. But without drilling too deep onto certain regulatory products, to all of you, what is if you talk to a regulator, what is your main concern? What is your wish with regard to regulation and long-term finance? Is it concrete single regulatory projects that make life hard, for example, like Basel IV, that is endangering whole areas of business? Is it secondly the amount of regulation, different regulation that is created, especially in the banking sector? Is it maybe also the difference in regulation, and maybe not the even regulation between banking and other areas of the financial industry? Or finally, is it the, let's say, the unpredictability of regulation, what you mentioned before, that you have, that in long-term finance especially, you have the problem that you basically grant a loan of 10 years and you are unable to price it, or it's difficult to price it, let's put it that way, because you don't know which regulatory costs will add up in 4 years' time because of initiatives that you don't yet know about today. So
the first answer is obviously long-term financing has something to do with your ability to raise funds. And first thing is, if you have assets, you can securitize, otherwise not. If you have a good rating, you are able to fund in the market. The problem in Germany these days is that some banks and some corporates have a better rating than the banks. So they can much easier refinance themselves in the relevant markets. So perhaps we have a special situation in Germany, but we have the same in Europe. You know that the average ROE of the European banks is at 3%, yeah, compared to the US, where it's 7, 8, 9%. So we have obviously a disadvantage. And for me, it is not just the question whether you have a good rating. It's not a question of long-term financing. It is a question of your ability to raise equity and to cope with the demands of the regulation. And Herr Boekhout just mentioned this instability, this not knowing what comes next is one of the main burdens that we have. We talk about Basel IV, and nobody knows whether we will reach an agreement the second half of this year. We exactly know what would have been the outcome if in January they would have decided on the old proposal. Then some of the German banks would have an add-on on their risk-weighted assets of 20 to 25%, which is, of course, for the German real economy, a disaster. Because if you are not able to retain earnings, if you are not able to raise equity, I know that we have seen successful equity stories, be it in Italy, yeah, UniCredit, be it Deutsche, 8 billion, yeah, so it is not impossible. But it costs a hell of money. Yeah. And so the pressure on banks in terms of this regular environment, especially not knowing what are my conditions for the next 5 years, and my supervisor will ask from me, so what is your planning for the next 5 years in terms of risk-weighted assets, in terms of grow in certain segments, be it commercial real estate, be it corporate banking, be it corporate bonds. That is a very difficult exercise under this unstable environment. So regulatory matters, and all the elements that I just mentioned, the unweighted leverage ratio puts a lot of pressure on asset-based lenders. Yeah. The liquidity ratios, be it the short term, the longer ones, incentivize short-term lending. And it should be just the opposite. We should promote our ability to be long-term lenders to the real economy. But this is not reflected in the regulatory initiatives that we are seeing quite now.
And given all the challenges that you mentioned, you would still stay with your previous comment that you expect banking to be a dominant force in long-term lending. Because I mean, it's not only about not being able to calculate the costs of an engagement if you don't know what happens in 3 to 5 years, but it's also if you look at Basel IV and if you look at the additional regulatory capital required in worst case scenarios, this could also mean basically banks are being priced out of the market.
Whether they are being priced out of the market, I don't know, but it's true that there might be certain arbitrage, yeah, that business is shifted either to supranationals or to unregulated markets, which is completely against what the regulators would like to achieve in the future. Yeah, they need stability, whether it's stable banks or whether it's unregulated, so far unregulated partners. So that is no solution to shift the business, which is our core business, to unregulated markets. And at the end of the day, yeah, it is a survival of the fittest. So, you know, you can see it in the margins. The margins in the corporate banking business, be it in Holland, in Italy, in Germany, are coming down. It is you call it a buyer's market. It works against our profitability, and the outlook for banks, yeah, for 2017, 2018 is not very bright. I mean, we have some advantage at the moment. We have a stable economy, so we don't see loan loss provisions. But in terms of the earning capacities, it seems to be difficult. So, yes, regulatory environment matters and works at the moment against this important topic of our core business.
What would be your answer?
Probably, if I may add, the level of uncertainty is not only about Basel IV, yes or no. If you would read research and find market consensus from a buy side, you would see these days, which is good news, that the projected return on tangible equity for 2018 and 19 for European banks there's quite a positive outlook in there. But if you read through the footnotes next to Basel IV, you read what you have to read carefully, because it's not only Basel IV, it's fundamental review of the trading books, it's also target review of internal models. And this even increases the degree of uncertainty. And this is, from a point of view today, status quo. There is not a shortage of capital in order to provide long-term financing. But if you have this level of uncertainty and you talk about structures which is 10 years in the future, then it hinders you to do business today.
Well, one element that can be added that hasn't been mentioned yet is, in addition to the uncertainty of the regulation as such, is also still a misalignment, if I like to use that word, between local regulatory authorities and the European authority where we want to move. And they still don't always see eye to eye, and there's still a lot of tension between the local objectives of the regulator and the European objectives. And sometimes that is to protect local interests. Sometimes it's just a different view, a different philosophy when they look at a certain element of it, and how you should finance, for example, residential houses, i.e. the mortgage book. But it doesn't help us at all in the direction of a common European market or a European banking union. And again, to go back then to the discussion, at the same time, we do talk about the need of a European capital markets union, which once again, I fully subscribe to, but it's just not the only solution for long-term financing. And so the uncertainty combined with exasperated by a misalignment between local regulatory authorities and the European regulatory authority make it very tough for banks to put their balance sheet at work. And at the same time, obviously, the monetary policy of the ECB aims to do exactly that. So it's there's the bridge between monetary decisions and, on the other hand, regulatory decisions. If they would be better aligned, I think we have a lot of power that we can mobilize within Europe. You know, Europe looks good economically. To be honest, you know, we're in great shape, and I think we'll see from an economic point of view, great times still ahead of us. You know, I'm very optimistic, but there is so much power to unlock when regulatory and monetary policies would be a little bit more aligned. And I know we don't want them to be fully aligned, it's clear, no? But to go against each other is maybe the other end of the spectrum. No?
What is the influence on this specific area of business of the current monetary policy and the interest rate environment for you? Is it favorable in that it enhances or tries to enhance at least in investment in the real economy? Does it address the real problem? Is it something that you are looking critically at because once interest rates change, and if you are a lender basically focused on gathering deposits, that might bring you in a difficult position, like many of the savings banks, cooperative banks, and so on. How do you see the monetary policy with regard to the consequences on long-term finance?
Well, the question what banks are doing. I mean, we have maturity transformation. We always did it. And of course, under this very difficult interest rate environment, where every investor only likes to go short, depositor, and people who need a credit, would like to hit the interest rate for hopefully 20 years or something like this, So there is obviously a mismatch. But this mismatch was always part of our business. But under this severe conditions with negative interest rates, it can be dangerous, especially if we get a shift of 200 or 300 basic points up. We don't see it. We don't see it. Our life would be easier if we have a slow process of increased interest rates. But I mean, we have started this exercise perhaps in America, in the US, but Trump will obviously finance all his endeavors with debt, and people who like debt like low interest rates. So for me, the increase in what we'll see in America in terms of the interest is limited. It will go up to a certain extent, and we will follow up to a certain extent. So there seems not to be the danger that we get a fast shift in our interest rates that would jeopardize part of our banks.
And that makes it manageable for banks.
That makes it, for the time being, manageable for banks, but that is only one side of the interest rate environment, as I just mentioned. I mean, we are at least not in every place and in every region able to charge negative interest rates to retail customers. You are not doing it. From our organization, you hear it here and there. Sometimes you talk about fees, and now we have been encouraged by Mr. Dombret that this is the right way to promote your profit and loss account. So here. So we have to find a way out of a situation that works against our profits.
For the asset manager, certainly, as I mentioned at the very beginning, it's a search for yield. So, and this is all about risk controlling and risk management, because you have to advise your clients that once they want to achieve a certain return, they have to accept a higher risk appetite, and that's certainly critical. As Mr. Boekhout said, from a capital markets perspective, we are right now in an issuer market. So the issuer is going to very much benefit from a very low risk premium. And that's also infecting certain documentation standards. That's certainly to some concern. Most of our energy, to be honest with you, we don't spend too much, invest too much on the question of what is the impact today. It's much more how are we going to reading the future in terms of potential tapering steps. That might not happen in 2017 given the election year all over Europe. But I'm much more concerned about the steps and the synchronization of the tapering steps. That's pretty key for all of us and for all asset classes. If this is real estate, if this is corporate bonds, that this is where we are focusing on, and certainly try to advise as much as possible to have a very good expectation management and as a very clear and well-structured communication from the ECB side.
Well, I'm a little atypical here to the degree that I've always been a great fan of the ECB as the only European institution that has accomplished anything, to be honest, and has done this with great courage and energy, sometimes rowing against the stream. So I'm impressed with what has been done. And the monetary policy in the meantime, I cannot find, let's say, convincing proof that it has led to long-term financing. I'm not even sure it did to medium-term financing. I have a hard time finding proof for that, which was obviously one of the goals. But they had other goals also, which means was keeping Southern European economies afloat, and that worked. To be honest, increasingly we see evidence that what he aimed to achieve in macroeconomic indicators is starting to surface. So I guess the criticism is reducing a little bit, and I'm happy for him. Again, I think he is a European hero. But I can say that it has led to an enhanced or increased volume of long-term financing. I don't know any evidence of that.
No, me neither. The only thing is that some of the measures were explained by providing the real economy with longer-term financing. That was the reason for implementing some of the issues.
Well, there was one of them, but that was.
And then again, it kicks in what you just said is that obviously banks may not have a liquidity problem currently in order to lend, but they have a capital problem in lending to certain entities, which makes it then counterproductive.
Yeah.
The regulation.
A lot of banks are still in the middle of the process of balance sheet optimization. And so putting liquidity in the economy doesn't necessarily facilitate them in their balance sheet optimization program. And then increased capital requirements or the threat of increased capital requirements also is not an incentive to lengthen your balance sheet, right? You're going to build in a buffer, access to capital markets. The equity capital market is not obvious. So then what you do, you shorten your balance sheet in order to make the relative portion of your capital bigger on it. And so that is what's happening, and those are the contraproductive powers at work between the monetary policy and the regulatory uncertainty. And if once again, I would plead if we can align those better, we have a very, very significant economic power within Europe, to be developing extremely positive and strongly in the next couple of years.
We have 5 more minutes, and I just want to encourage the audience to ask questions. Mr. Povel.
Thank you, Jens. I have a question with regard to regulations, since lower interest rate is one, but regulations is another very challenging thing. If we are looking across the Atlantic, we hear Gary Cohn proposing a deregulation of Dodd-Frank Act, and that is with regard to equity, with regard to proprietary trading, and also with bank testimonial. How does that affect, at the end of the day, the long-term finance ability, and how does it affect the banking scenery in Europe at all?
Difficult to say. And initially, first of all, to what degree will they be able to liberalize? It's not an easy process. So I doubt that even the White House has the power to simply do this by decree. So they can go down that process, but before it actually translates in a liberalization of the financial services industry in the US, I doubt it. It's not going to be a shock effect. So if anything, it's going to be an evolutionary process. And then the relevance for us is in the competitive landscape between European banks that have to some degree also a global presence and US banks. And so then we actually come back to Basel discussions. Okay, how do we play this game? Under the circumstances, it's not helpful to find a compromise under Basel, because if further deregulation in the US goes in exactly the opposite direction as regulation in Europe, the negotiators at the table to come to Basel agreements are going to say, whoa, wait a minute, now I need to watch out what that mean for me. So if it were actually to happen, it's going to take a long time to happen, and it will depend on how the European banks develop. I don't see a shock effect in any way, form, or shape, and I don't see short-term effects either from wild speculation about deregulation in the US.
But it could, of course, happen that all these initiatives by the US under America First could even improve the situation of the American and the US banks, which is compared to the European banks already now much better. And it's interesting when you follow the press of these days that you have Madame Nui encouraging the European banks to merge, and Mr. Riegler from FÖB today, he has been asked at the Wirtschaftsjournalistenclub one of these evenings, he doesn't see any chance that this would happen. But what could happen, of course, is if there is so much overwhelming earning power of US banks that they will just take the money and buy into the European banking market. For the time being, that is not an issue because, well, they feel that the ROE that can be offered here is not of interest. But that could change, depending whether this gap between earning powers in the US and the European banks will even deteriorate from our side, yeah, then these things could happen. Yeah.
Yes. For the micro.
Hi, Cornelia Meyer. I have one question. Looking at European banks, they have traditionally been very international. I used to work for one of them and do project financings all over the globe. Given Basel III, Basel IV, where do you see the European long-term banks in terms of the appetite of banks for long-term finance in more adventurous places such as emerging markets where you get better returns, but obviously you also have then the risk element to it. Where do you see that there's a proud past in that? Do you see a proud future in that?
Well, I still see a proud future in it, to be honest, because, well, first of all, these countries need those financings also, so somebody needs to provide them. So there will be a balancing, so that pendulum will somehow move a little bit closer to the middle. And there's mitigating measures that we can take, particularly also for those countries. Obviously, by credit enhancements from the IFCs and the EBRDs and the credit assurance agencies. So they'll have maybe more work, but that money will be provided. Maybe there will be dip, of course. But once the pressure comes up, solutions will come either by credit enhancement or the credit insurance agencies, or by alleviating the pressure. But I still think that there's a proud future for it also. Yes, because who else is supposed to do it? To be honest, no. I mean, if you're going to have to wait until the IFC funds all these projects, it's not going to be this generation. No?
Yeah, for me, it's certainly not the right question, because we are very concentrated on the domestic market, on the German market. But having said this, of course, when we finance the German corporates, the big ones and the small ones, so we also finance investments in foreign markets. For me, it's interesting that we have seen in the past not an increase in the internationalization of banks. We have seen a more cocooning view. And what I've felt and what I learned in my professional life, that's a question of cross-country risk, of transfer risk, of political risk. Yeah, this book is written every day, more or less, again. Yeah, so countries who have had no problems in the past, yeah, out of a sudden, yeah, be it Hungary or others, yeah, Poland or Russia, yeah, out of a sudden are very, very difficult markets. Or I mean, who does people feel who are heavily exposed at the moment to Turkey? What about Great Britain? Yeah, it is not a transfer risk, yeah, but when I see all these letters that we just receive from the regulators, yeah. So what are you doing in London? Under which scenarios do you plan? And say you have to plan 6 and 7 scenarios, and finally, after you have discussed this with London, you have to discuss it with the ECB, although the politicians haven't taken the decision. One of the decisions could be we just leave the market. Yeah. So is it a good time to internationalize your banking business? I'm afraid I have to say it is not. I mean, with ING, you are a strong global player and you know the markets, so you have decided to do so. My question was, is it now a good point in time to start with this exercise? No. And there I would say, be careful. Yeah.
Couldn't agree more. Couldn't agree more.
So Rüdiger? Any comment, or?
We as you can imagine, we are focused very much on our domestic business. Where we finance internationally, that's very much driven based on the fact that we are an equity investor on commercial real estate. This is where we are locally present. This is where we understand cross-border issues. This is where we understand BEPS. So in this environment, we are focused on probably globally 30 urban centers where we believe we understand the market dynamics and pricing features. but nothing other than real estate.
Okay, which brings us to the end of this panel. Join me in thanking the panelists for their contributions. Thanks very much for an interesting discussion. Thank you very much.